Hello, and thanks for tuning in to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start as we usually do with our chart of the week, and we titled this one Capital Flows Telling the Story. We've gotten a number of questions recently around the status of the US dollar and whether or not the dollar could be losing its reserve currency status or whether the dollar could go through a prolonged period of severe weakness. And we thought it would be a good idea to kind of take a step back and see what foreign investors are actually doing here from a dollar perspective. And this top clip in this chart shows the net foreign purchases of US dollars and stocks over the last 12 months. And you can see that it's actually at a record high level. And the year-to-year change in the bottom clip shows that it's been growing as well. So the dollar can go through cyclical bull and bear markets, but there's still ample demand for U.S. assets, as shown here in this chart. And while that remains the case, it would be difficult for the dollar to kind of lose its status amongst the global currency space. Now, the dollar has been somewhat weak over the last year. It hasn't been a disaster, but it has been somewhat weak. And that trend has continued this year. And we can see that in the dark green line here, where the dollar is down a little bit under 1% for the year. That actually has had the effect of supporting riskier assets. So the other line that I want to draw your attention to is that brown line that shows 0.1%. That is the bond market. So the bond market's been very stable, and it was stable last year, and the dollar has been lower. And those two trends have helped provide some support and a tailwind to riskier assets like commodities and stocks. And one of the things that we can see that has passed through from 2025's trends to today is international stocks are continuing to lead over large cap US stocks. Another interesting trend early in the year is that small cap stocks have caught a bid, being one of the market leaders here. So we'll look to see if that trend can continue and potentially look to allocating to small caps a little bit later in the year. Now, when we think about the economic data that we've been getting good data on jobs since the government reopened. A lot of that data was behind, but now we're getting caught up. And we can see here that job openings, the blue line, has kind of been falling really since 2022 and has started to stabilize at a level that we think is consistent with the unemployment rate not really moving from here. That would be a good trend. If the unemployment rate were to move higher, that could cause some more economic pressure. Now, another thing that we've seen here is almost in lockstep with job openings easing has been an easing in wage growth pressure. So you can see that wage growth got all the way above 6.6% and now is running at a 3.8% rate, which is a lot more tolerable for corporate profitability, but it also takes pressure off of core inflation. And we can see that in the orange line here, where core inflation has subsided quite a bit, and it's stabilized out in the high 2 levels, but much better from an inflationary backdrop than we had a couple years back. Now, income's easing. That's something to watch because it's also easing and putting pressure on spending. So here in this chart, we're showing in blue the year-over-year change in consumption expenditures, and it's still pretty healthy at 2.5%. It's below the average gain in expenditures. And you can also see in red the dashed line, that's real disposable personal income. So incomes adjusted for inflation is running at a pretty soft rate now of 1.2%, also below the average. So it's fine that the job market has eased to this point. That's taken pressure off of inflation, but we really want to start to see stabilization at these levels in the job market to avoid consumption really taking a hit here as we move forward in 2026. We're not in a recessionary camp yet. These are just some things to watch from an economic perspective. Now, another big thing going on right now is that earnings season is well underway. And the results are expected to be quite solid. Here in that top line is just the S&P 500 index. You can see there's 500 stocks in the index. And sales growth is expected to be 7.7%, with earnings growth expected to be 8.1%. So those are solid results, if not blockbuster, kind of gangbuster results in earnings. The upshot of that is that the market does not typically get into too much trouble as long as earnings growth remains positive. And that's what we expect here to show for the fourth quarter of 2025 and into the first quarter of this year. Now, one of the drivers of earnings, so sales have been pretty solid, but earnings have consistently been outstripping sales. And what that implies is that profit margins have been expanding. So here we're showing profit margins for the S&P 500, and you can see that margins are almost back up to their all-time high, and have been pretty consistently marching higher since 2022. So that has been on the back of some productivity improvements here in the economy. Now, we might think that a lot of the fundamentals are really good news, and they are when earnings are growing, when margins are expanding. Those are good conditions, but we also have to take a look at valuations and see how much of that improvement is likely priced into the market today. And this chart here shows the median forward price to earnings ratio among the S&P 500 companies. And by using the median, that strips out the outliers where valuations are really high or really low. It just grabs the middle stock. And you can see here that valuations are about as high as they get on a forward earnings basis for the median stock in the index. So what that implies is that a lot of that good news that I just talked about, well, from an earnings and a margins perspective, is likely already priced into the market. Now, one of the things we've noted so far early in this year is a little bit of a leadership shift. And that has been good news so far because it's resulted in a broadening trend in the market. So sectors that had been laggards, like energy and materials, consumer staples, have been strong leaders so far this year, and that's helping to improve the participation. Now, what we don't want to see a continuation of is the bottom two sectors are information technology and financials, and both of them are thus far slightly negative in this short year. We want to see those participating. They don't necessarily have to be the best performers, but we want to see positive returns in those sectors. Those are the two biggest sectors in the index. Information technology is the biggest growth sector, and financials is the biggest value sector. So it would be difficult for a cap-weighted index to perform well if those two sectors are negative on the year. So that's something to watch. Thus far, the trend in broadening has been a positive, but we want to see if financials and tech can also start to put in some positive performance as the year progresses. Now, one of the things that we've noted is there is quite a bit of pessimism on the economy out there. We're showing here in blue the index of consumer sentiment that comes to us from the University of Michigan poll. And you can see it's at about rock bottom levels. And then in orange, we're showing total stock allocations. So this is a little bit different, as total stock allocations of about 71% is about as high as it gets, and that has really diverged from consumers' attitude on the economy. So you do have this kind of wall of worry from an economic perspective, but investors are pretty fully invested. And that means that even if consumer sentiment were to improve, there just may not be that much money on the sidelines to come into the stock market and push it higher. Our expectation for this year is a year that's a little more muted from a return perspective because of several of these factors. So our closing thoughts for the week is we looked at the chart of the week, and we wanted to just take a look at what investors are actually doing versus kind of the fear of what could happen to the dollar. And capital flows are certainly robust into U.S. financial assets. So the dollar can experience cyclical bull and bear markets, but it does remain well demanded in the global landscape, and I think that's important. Now, much like the trends in 2025, that weaker dollar has actually been a tailwind to riskier assets like stocks or commodities. And stability in interest rates has also helped as well. We've seen international stocks continue to be leaders, and now small cap stocks have joined the party and been catching a bid. Now, the labor market does continue to ease, and that's putting downward pressure on core inflation. But we want to see openings really stick around the level where they are today, just to keep that unemployment rate where it is. A rising unemployment rate would likely be recessionary if it were to kind of break out from its low 4 level that it is today. Now, the downtrend in annual income increases, that is putting some downward pressure on spending. As we've shown, it's not yet recessionary, but that's something that we want to keep an eye on. If there continues to be deterioration in the labor market, if there continues to be weakness in annual income growth, then it stands to reason that spending would follow suit. Now, earnings season is underway and the results are expected to be solid. Profit margins continue to expand. Rising productivity has been a big part of that story, helping to boost profitability. But valuations are pricing in a lot of good news, and we need to be cognizant of that. We have seen thus far this year rotation away from the largest growth sector, which is technology, and the largest value sector, which is financials. And thus far, that's been positive for the technical indicators that we follow. But we do not want to see outright weakness, negative returns in tech and financials this year. Otherwise, it's going to be very difficult for the indexes to make up much ground. So for now, the market is climbing this wall of economic worry, but investors are already highly allocated to stocks, and that does present a risk if demand for equities were to dry up. For now, we're going to continue to give the bull market the benefit of the doubt, but the margin for error does appear to be narrowing, consistent with a bull market that has been ongoing really for over 3 years now. So that's our anticipation, is potentially a more volatile, more challenging year, but not necessarily a negative year in 2026. So that's what we have for you today. And as always, I want to thank you for joining us and wish you a terrific week ahead.